Hey you guys, thanks so much for tuning back to the channel. So today I'm going to be covering the SPY, which is the ETF that covers tracks the S&P 500, which is pretty much an indication of the overall total market. And we're going to be going over the current price action of the SPY and kind of where I think the stock market is headed. So this is going to be kind of a technical interview mixed in a little bit with Sorry, this is going to be a technical analysis kind of mixed in with a little bit of sentiment. So I just want to kind of give you guys a heads up. If you aren't overly technical with stock charts, I'll try to simplify it. But if you are, then this should just be a breeze. So if you all aren't familiar with Fibonacci retracements, this is a technical indicator that a lot of traders use and also investors as well. People who invest long term that want to determine the overall trend of the market or certain support or resistance levels when they get in. This is a very, very common indicator that gets used that you actually will notice. You can apply to a lot of things from a mathematical standpoint, but it's for the sake of technical indicators, this is a very, very powerful one that a lot of traders seem to use. And no matter the market conditions, it seems to be relatively accurate for the most part. So if we throw in the Fibonacci retracements, we start from the top and we bring it all the way down to the actual complete bottom part of the lowest candle. We can take a look here and we can see that the market has actually retraced well over 50%. We're actually now looking at the 78.6%. So what does this mean? So for those of you who are not familiar with the Fibonacci's, anything typically over a 50% retracement usually indicates a trend reversal. Okay, so that means that the stock has been trending down. It pops up to the 50%. Usually it'll retest a little bit, and then if it holds and it goes through it, then you know that it's a trend reversal. And that's actually exactly what happened here. So if you go back to the 9th of April, April 9th, April 9th, 10th, and then you kind of go over to the 14th after the weekend, it popped to the 50%. It went up, it went down below it, and then it immediately went back up. And then here is where I would have given the indication that this would be a good entry point because it looks like it's going to hold, and it has. It went up to the 61.8, went back down, retested again, and then it's gone back up. So where are we right now in terms of the overall health of the economy? It really depends on who you ask. So there are a number of people who think that the bottom, if you will, is in, and that we're not going to see that anymore. There are a number of people who think that we are going to see a significant pullback, but it isn't going to be anywhere near what we originally had back in February. And then there's some people who just say, "Hey, we don't know." Now, the reality is, no one actually really does know per se. But if you're asking me, if you take a look back at the monthly, okay, from the last two recessions that we've had. We had one in 2002. You take a look here, the stock went from 153 down to 78, and then it literally just kept going. Right? It just meant that was literally the bottom. It never actually retraced more than 50%. 153, 108, pulled back here, right? And then it just continued down. If you take a look here in 2002, right? So when we had the other, 2008, I'm sorry, when we had the other recession, I said 2002 back here, right? I hope I did. Yeah, so take a look at 2008. I mean, it just flat out crapped out, right? It had a little bounce here, it just flat out crapped out. And then came back down here, hit the 67.10, which actually wasn't a prior support at all. There was support here at $80. This, if you would have bought it here around $80, you wouldn't have been in a bad position. But the lowest was 68, and then it just snapped back and I never looked back. All right, so it was a huge, huge pullback. But keep in mind, this is over a period of months: 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 months, which was a year and 6 months. Let's fast forward over here. 2 months. I'm going to say that again, 2. So either this is the beginning of another recession, or this is a pullback, and this ain't a recession. So typically when recessions occur, no one really knows when they're going to occur, and there's never ever one thing that causes a recession. it's usually a culmination of over leverage, markets bursting, bubbles bursting in a number of sectors. It usually occurs after there's just a ton of jubilation in the markets and everyone's making lots of money and there's tons of complacency. And then all of a sudden, boom, bubbles pop, bubbles burst, and then the next thing you know, recession. Taking a look here from on the monthly chart, the stock has the SPY. The ETF has gone from 339.08 down to 218, 219ish, if you will. Yeah, that's well. What do we got here? We got it somewhere around the 220, 218, 219 range, and then it's just fully retraced past 50%. Looking at it from a monthly standpoint, this is an indication that there is a trend reversal, meaning that we are not going to see these bottoms again unless there is some type of additional external factor, like, let's say, heaven forbid, a second viral outbreak, or something else externally from an economy standpoint, economy international standpoint, that occurs. Now, there are those people that say, well, this is just the first phase, and we have, as of today, May 28, 2020, we have now over 40 million Americans that are unemployed that are being provided for by Uncle Sam. We have company earnings, Apple, Facebook, that have missed earnings, so companies aren't making any money right now. People are laid off, but the market is just rebounding, and everyone's kind of like, well, what the hell's going on? And what's going on right now is you have the Federal Reserve that stepped in with the stimulus package, and they have provided so much liquidity to the financial markets. And when they do that, it provides liquidity to the large institutions. So they actually they lend money to each other at what's called the prime rate, which is the rate that the banks lend to each other. And it's extremely low. And then when you, a regular lender, or me, a regular lender, goes through and wants to borrow money from a bank, they then tack on points above the prime rate based on our credit rating and all that good stuff. So when the Fed lent money out, when the Fed gave money out, if you will, to these large institutions, it helped provide liquidity into the markets. And all of the big institutions and all the banks and all of the big enterprise companies have been provided additional funds and liquidity that they didn't have as a result of people not buying their products, like Apple, right? So let's do a quick look here. Take a look at Apple. I want to go over to that's not Apple. Let's try this again. Let's try that again. I was like, whoa, that ain't Apple. There we go. Apple is back. I mean, this is almost funny. Apple was almost back to all-time highs. So what I am personally seeing in the market is I am seeing a contradiction of indicators, and I'm going to tell you why I say that. What is this? Back in January, so let's say basically the beginning of February, when Apple was at 327, everyone kept saying there needs to be a pullback. So the stock had gone up from $150 to $300. It literally doubled in a year, which is insane because this is $1 trillion stock. And stocks just don't typically do that are this large. That's typically a price movement that you get from mid-cap stocks or growth stocks. Apple, an industry leader, a stock that the entire stock market follows, they almost mirror each other. That stock was up 100% in 2019. So people were expecting a 20-30% pullback. And they got it. They actually got the pullback. And then it immediately got bought back up. And then here we are again back at new highs. And what I'm seeing from a contradictory standpoint is that when this pullback took place, 4 months it dropped. 1, 2, 3, 4, 5. 1, 2, 3, 4. Okay, 3, 4, 5. The fifth month was down. 6th, 7th, 8th, 9th. Between the 9th and the 10th month, almost a year. 4/5 of a year that it took for Apple to get back to its current highs when that pullback occurred. 2 months. That's all it's taken. 2 months. 1/5 of the time. That's not normal. And the reason that's not normal is because that tells me that the stock market, meaning the large institutions, either A, believe that this was just fear, and that the threat of the market falling is significantly lower now, or this tells me that this is just the Fed saying, yo, we're buying everything, so don't worry about it. You good until something else happens. And the reality is we just don't know. So if we go back to the SPY, let's go back to the SPY. Come on, Weebull, you know I love you. Come on, let's step it up. There we go. If we go back to the SPY, conflicting indicators. All right, so it's gone over the 50%. This indicates a trend line, but the aggressiveness in which it's gone over the trend line is what I'm uncomfortable with. The SPY has had the most volatile moves from a down point into inflection back up that it's ever had in the history of being in existence. Let's look at it. It's never happened before. 1994, right? I mean, I'm running out of chart space, so I can go back like 20-some years or 25 years. It's never happened. When the stocks fell down here, it's taken, I mean, look at this, 2002, it took, it took 4 years for this to get back. 4 years. So if you're 20, you were 24 years old when that happened. And then 2008, I mean, this took, what are we talking about here? This took another 4 years. Okay? And then now we're talking about it's halfway there in 2 months. That's just not realistic to me. So the stock market is telling us that either we think that this was just fear pullback from this overblown pandemic, and the Fed is going to bail everybody out, and we good. You know, like I like to say, homie, we good. Or this is kind of a gluttony pullback because the Fed has stepped into which they've never done before, and they literally said, we're going to bail everybody out. Don't worry about your earnings. Don't worry about who's buying iPhones. Don't worry about advertiser money on Facebook. Don't worry about any of that. Just keep doing you, business as usual. Don't worry about your earnings. So Facebook came out a few weeks back, and they said that their earnings was missed for the first quarter. And their future guidance was lowered for the second quarter. 99% of the time when a company comes out and says, yeah, we missed earnings. Oh, yeah, by the way, next quarter is going to be bad too for the next 90 days. Stocks go down. Even if it's 3, 4, 5%, the stock goes down. Facebook stock went up like 5% the next day. I mean, it's crazy. So there's obviously a significant conflict, not conflict, excuse me, there's a significant, well, yeah, I like, yeah, let's use that. There's a significant conflict in the indicators. You know, at some of these indicators, I'm saying that this is going to be a pullback. Some of these I'm saying it's not. So the next question is, how do you play this market? And I think the question really comes down to, are you a trader or are you an investor? Now, if you are an investor, you're probably still buying because, you know, why not? I mean, it's still, if you take a look from 305 to 338, it's still about 10% off the highs, right? But it's gone from 220 to 300. I mean, it's literally gone up 40% from the lows. So some people are saying, well, damn, it went up 40% for the lows and we only got 10 more percent left. You know, I'm waiting on another pullback. And I think because we're waiting on another pullback and the sentiment is wait on the pullback, that it's not going to pull back. Personal opinion. The way that the stock market's a very devious entity, right? So it likes to go opposite of whatever the main sentiment is. And if everyone, when I say everyone, I really mean retail. If everyone is expecting this pullback because we all still remember that this extreme drop and we're still in the corona phase, to me, that means it's not going to pull back. I think it's too obvious. And I think because of that, we're not going to see a pullback. So what do I think is going to happen? I think we're going to retest the new highs. I know that's a bold statement, but I think that's what's going to happen. I think we're going to retest 340, and I think we're going to retest 340 because people think we aren't going to retest 340. I think it's going to go back up to 340, and then I think we're going to probably come back down and retest 292. So if we do that, that'll be a 15-20% drop. I think it'll consolidate a little bit, and then maybe we go higher. That's my guess. Now, if we get, let's say hypothetically, another outbreak, or if some significant tariffs take place between the president of the U.S. and the dictator of China, if anything external happens that significantly affects the economy even more, let's say that heaven forbid, all of the 40 million Americans that aren't working right now, providing to the economy, can't find jobs, and the government doesn't approve a second stimulus package, which I think they will, or let's say that they do, but the second stimulus package isn't enough, and then they have to keep, providing stimulus packages. Then eventually they go, we can't continue to do this because our budget has just gone up exponentially. Excuse me, the debt. So then so then we actually start to begin to feel the effects. So the next thing you know, we're in a significantly deep recession. So from a trading standpoint, I'd buy any pullback right now. I really would. I would, and I am personally. From an investing standpoint, I see nothing wrong with putting some money into the market right now. There's nothing really externally from a news-wise standpoint that I think that's simmering that can cause the stock market to pull back, because right now the entire stock market is literally trading with free money. All right, so this is not your typical bounce back. This is just typical Fed has infused $1 trillion plus into the entire U.S. economy. Actually, $2 trillion, but $1.5 trillion if you're counting the amount of money they put into the institutions. And this is companies literally just trading with free money, fun bucks. All right, this is like Wolf of Wall. They're just fun bucks at this point. There's no real value attached to them. And so because of that, you don't trade this market based on the saying that it's up over 50% retracement, so and there needs to be a pullback. It doesn't. There doesn't have to be a pullback. And I don't think there's going to be one for the foreseeable future. So that's just my 2 cents. Hopefully this has been very beneficial to you guys. If we do get a pullback and you guys are looking to enter in a trade, buy somewhere here at 293 level. If you're investing, there's never been a greater time to invest than now. So that's that. Oh, one last thing I want to also reiterate as well. Do not try to time the markets. Don't do it. I've been trying to do it for 10 years, and I can't tell you how much money I've lost. A lot. Trying to time the markets. And what I mean by that is trying to find the bottom. When this crash happened, right, people are like, oh my God, where's the bottom? I don't want to buy here. Oh, I don't want to buy here. Oh, I don't want to buy here. And then the next thing you know, it's all the way back up. Real investors, people who are in it for the long haul, people who have been investing for years and putting money into the markets. And when I say investing, I want to also clarify something else. I'm not talking about necessarily hundreds of thousands of dollars. I'm talking about $500, $1,000, $1,500, whatever you have to invest. All right, because that's there's no dollar value that's added to investing. Whatever you can comfortably put in while still having a savings, that's investing. So, people who are investing are buying when the stock market falls down. So when stock market hits this level, falls down, you see a little green. Okay, I'll go ahead and put in a couple thousand or whatever, 10% of your investment, whatever you're comfortable with, or 20%. Oh man, it stock's down again. Okay, you know what? I'll throw in another 20%. Oh man, it's down more. Okay, I'll just keep throwing it in and just keep adding. That's called dollar cost averaging, and that is the number one way to make money in the stock market. That's it. So unless you are a top 1% day trader, which you very well may be, and then in that case you're making money hand over fist every day, the number one way that most people make money, including Warren Buffett, in the stock market is the dollar cost average. That's the only way. Stock market falls, you put money into it, and you walk away. Falls another 10%, you don't panic, you put more money into it, and you walk away. So that's kind of where we're at with this, guys. So I hope this was beneficial. I hope this gave you all some insight into the sentiment of the market in terms of what I think is going to take place. Just to kind of reiterate again, I don't see anything from a newsworthy standpoint, anything brewing per se, that is going to cause the stock market to crash or to significantly pull back right now. There's a ton of free Fed money that everybody seems to be having right now. The unemployed people are getting $4,000 a month. The banks are getting trillions of dollars, and institutions are getting tons of money, and the Fed has come out and said that we're going to support the markets. Not we're going to, we're gonna support the markets indefinitely. That's a very strong statement by the Federal Reserve, and you don't want to trade against those guys. So that's it. My sentiment right now is I'm long. If you guys have any questions, make sure you leave your likes, comments, concerns, gripes, moans below. If you haven't already, please make sure that you like and you subscribe to the channel. So this is a financial education channel. I don't have all the answers, but the answers that I do have, I am happy to share. A lot of people who have financial channels, they do it just for our pure entertainment, which is great. Hey man, I like to watch videos that are fun and entertaining, but I also want to make sure that I educate as well. So hopefully you guys found this very beneficial. You found it substance driven. Make sure you like and subscribe, but also please leave comments below. I want to know what you guys think about the video, and I also want to know what you think about the upcoming, I should say the upcoming next 6 months into the year 2020. And also, I want to know what you guys would like to see in the next upcoming videos. If there's any topics or questions you guys have that you'd like to have discussed. And other than that, thanks for tuning in, and I'll talk with you later.